Thinking about buying a rental property in Florida? You're not alone. It's a question that we get asked all the time. I'm Nigel with the Rockstar team, and we've been working with investors to purchase brand new, purpose-built rental properties in Florida for a few years now. But buying property in the US is a totally different ballgame compared to Ontario. Different rules, different taxes, different financing, different landlord laws. So in this video, I'm going to walk you through exactly how Canadians are buying Florida investment properties step by step. No US credit required and without the confusion. Let's dive in. Step 1. Start with your why. Before you start looking at cities or properties, the first step is getting clear on your goals. Why are you doing this? What are you looking for? Is it for cash flow, long-term appreciation, a vacation property you'll eventually retire into, or are you looking to simply diversify from Canadian real estate to get some eggs in a different basket? Getting clear on this will help you decide what kind of property makes sense and how hands-on you want your investment to be. For all intents and purposes, today we're going to focus on the type of investment that we get asked about most frequently, which is the built-to-rent model. If you're unfamiliar, these are brand new properties designed specifically for renting out. Another reason this type of investment makes a lot of sense for Canadians is that it's about as close to truly passive and hands-off as you can get, which is key considering you're a multiple hour flight away. So start with your why, everything else builds on that. Step 2, choosing the right location. It's important to remember that by population, Florida is huge. Florida has a population of 24 million people, while all of Canada is around 40 million. So as Canadians, it's important to remember the sheer size of the state and recognizing that there are serious differences between different areas and major cities. So take the time to understand local laws and trends in the areas you're considering. This decision alone can make or break your investment. We've seen it. Investors find an inexpensive fixer-upper where the numbers work, they proceed with the purchase, do some work on it, just to realize that the property is barely insurable after work is done due to location and building standards. Step number 3, understanding financing. Until somewhat recently, it was quite difficult for Canadians to get financing in the US. So Canadian investors were left with the decision to buy in cash or steer clear. That's no longer the case. As a Canadian, you can now get mortgage financing under the Foreign National Mortgage Program. And we've seen as low as 25%, but mostly ranging anywhere from 25 to 40% down payments. You might be thinking that 25, 30, or 40% down payments is high. Although it's definitely higher than what Canadians are used to, it's important to remember the difference in property acquisition prices. The average sold price in the GTA for June of 2025 was approximately $1.1 million. That would put a down payment of 20% at $220,000 Canadian. One of the recent properties that we've had an investor close on was a $260,000 single-family home in Citrus Springs. So even with a down payment of 30%, that puts the out-of-pocket cost at $78,000 USD or $106,000 Canadian. Still less than half of the 20% down payment in the GTA. So housing affordability really plays a role here. Now, how do you possibly get a loan without any US credit history? If you're a Canadian with no US credit history, no problem. Specifically, when purchasing an investment property, the mortgage companies can approve you strictly on the performance of the property. They call it a DSCR loan, Debt Service Coverage Ratio. So as long as the monthly rental income on the property covers the monthly mortgage payment, you're approved. Well, almost. The last step will be to show proof of reserves for 12 months, which is proof that you own some sort of liquid asset that can cover 12 months worth of mortgage payments. These reserves don't necessarily have to be cash. They can be in stocks, RRSPs, or even things like Bitcoin, depending on the lender. The lender will usually need to see your down payment and closing costs in a US bank account for at least 30 days before closing, which is what we're going to talk about next. Before we do, something else to remember with mortgages in the US is that the US standard loan term are for 30 years and don't have the renewal terms that we do here in Canada, commonly every 5 years on a 5-year fixed. There, the rate that you get on day one is good for 30 trips around the sun. So that makes the initial interest rate on purchase very important. There are ways that you can break a mortgage and refinance a few years down the road, but that's a little bit more nuanced and not something that we're going to get into today. Step number 4, choosing the right legal structure and getting a tax number. Opening up a US bank account is an absolute must to be able to get a mortgage in the States. But to be able to do this, you'll need to get a US tax number. These come in 2 major forms, in something called an ITIN or an EIN. ITIN stands for Individual Taxpayer Identification Number, and EIN stands for Employer Identification Number. These are both ways for the IRS to identify you, and the status that you select will depend entirely on the structure that you plan to hold your properties in. As the name suggests, if you're buying in your own personal name, you'd apply for an ITIN, individual. Something to note is that the current processing time for an ITIN is at least 2 to 3 months. So if time is of the essence for you, this might not be the way to go. Okay, so there's one more major factor when deciding on structure that we need to talk about, and that's that Florida has a reputation of being a highly litigious state, which is why most investors that we work with opt to purchase in a corporate structure to better protect against legal action. Quick disclaimer, I am not a tax specialist. We're just here sharing our experiences. We absolutely recommend that you contact a cross-border tax specialist when making these types of decisions with your investments. So the structure that we're most commonly seeing investors purchase in is a combination of an LLC and an LP, which would have you applying for an EIN. Current wait times for an EIN are approximately 5 to 7 business days. So we're talking days and weeks instead of months, in contrast with the personal route. Okay, so why this structure? It comes down to 2 major factors: liability protection and tax implications. With the LLC, if you ever face legal action for something like a slip and fall, for example, the potential damages are limited to whatever is in that corp and goes no further. So on a personal level, you and all your assets are completely protected. However, the issue with owning in an LLC only is that the taxes paid in this structure to the IRS are not recognized under the USA-Canada tax treaty, meaning that as a Canadian, you don't get credit for the tax on income you already paid in the US when reporting in Canada, and you will be double taxed. That's where the limited partnership comes in. An LP is considered a flow-through entity on both sides of the border, meaning that taxes claimed on the US side of the border are accounted for when filing your Canadian taxes. And if the Canadian tax rate is higher, you will only be responsible for the difference between what you've already paid to the IRS and the total amount assessed in Canada. Again, this is something to discuss with your accountant, but it's important to decide early so you can structure things correctly from the get-go. Step number 5, open up a US bank account. Once you've got your structure in place, you can now open up a US bank account with the tax number that you obtained in step 4. You'll use this to hold your down payment, pay closing costs, receive rent, and manage property expenses. Again, keep in mind, your funds need to be sitting in the account for at least 30 days before closing to meet most lender requirements. Step number 6, select the right property and fund your US bank account. Now that most of the tedious stuff is done, it's time to have some fun and go shopping. Again, keep in mind how crucial the market is that you select and the property type. Don't forget your why and the goals of your investment. Once your property is chosen and the offer is accepted, you'll sign the agreement and wire your funds into your US bank account. You'll need to show proof of down payment, proof of reserves, and documentation to support your financing, all of which we outlined earlier. Then it's time to close and line up property management if you're not planning to be hands-on. And congrats, you officially own property in the state of Florida. One more thing, we've mentioned insurance a few times and feel it's something that needs addressing. We've all heard the headlines and been told by a neighbor or a colleague that properties in Florida are nearly uninsurable. While that might be the case in some situations, it greatly depends on the property that you're buying, specifically when it was built. In 2002, Florida adopted a new building code standard, which became the strictest in the nation due to the frequency of hurricanes and floods. It was later updated in 2017 to become even more stringent. Now, the first question insurance companies will ask is when the property was built. Standards like height above sea level, depth of tie downs are all accounted for. And in our experience, when insurers know that it's a newly built property that's to code, getting insured is a breeze and relatively inexpensive. We've seen investors secure insurance for under $100 a month in the state of Florida. Buying an investment property in Florida doesn't have to be super complicated or scary once you know the steps. Start with your goals, pick the right market, get a tax number, get financing and structure in place, and most importantly, surround yourself with a good team. If you're interested in learning more and seeing how investors that we work with are buying low maintenance, cash flowing investment properties in Florida, we fly down twice a year for educational property tours to have a look at the specific properties and markets down there with our own eyes. We bring in experts like property managers, mortgage brokers, cross-border tax specialists, and home builders to give the inside scoop on it all. If you're interested in joining us for one of these tours or want more support or access to the tools we use when investing in Florida, simply reach out to members@rockstarbrokerage.com and we can help you find what you're looking for. We'll catch you on the next episode, and thanks for watching.